Good morning, and I want to welcome everyone to our 40th episode of In Conversation with Convergence. I'm George Evans, and as you guys know, this is a monthly podcast where we feature our clients and special guests, and we help you to get to know the market leaders and some of the top issues facing the industry. I'm joined today by a terrific and great guest, someone I know for a long time, John Carson. And John is the head of sales for Alternative Fund Services at SEI. Believe it or not, and I didn't know this till this, that John is with SEI almost 29 years. So you started when you were about 11 or 12, I'm guessing, right? Hey, John, welcome. I'm very happy to have you join me today.
Thank you, George. Appreciate it. Really looking forward to the discussion today. And I was curious if you're just running down the alphabetical list here, Cass, Carson, and who's next? Curly next, somebody else.
We're working our way through, and we kind of mix up lots of different service providers, right? Administrators and primes and custodians and audit firms. We even had on not too long ago the Assistant Secretary of State. So. Wow. All right, so John, I'd like our listeners just to know a little bit about you first, right? And if you could talk a little bit about, I think right out of school you started SEI, and I'm sure you've done a number of things, but be curious kind of on the path you were on, and you could take our listeners through that a little bit.
Yeah, sure. I appreciate that. Yeah, I'm a lifer. I came to SEI right out of college as an accounting major and got a job here. Was extremely thrilled to be getting a job in 1994, and did operations for a few years. Discovered that I was terrible at it. Not a very good experience for me. I thought I was an accountant, and turns out I really wasn't. I switched roles into a service job for a while. Became a relationship manager, and got the feeling of dealing with clients. And products and cross-selling and a lot of good skills learned during that window. And then I think it's since 2005 I joined the business development team here at SEI on the alternative side of the business, and I did that for 16 years I think it was, where I was carrying a bag and out in the marketplace and calling on prospects the entire time, new names, new logos, and enjoyed the heck out of that. Really felt it was something that I just got comfortable with very quickly. And at some point, you start to get a little long in the tooth. Some leadership changes occurred, and I took over as the business development lead for the alternative segment. And then I think, as most people are seeing in the marketplace, as markets are consolidating on both the alternative and traditional segments, I've recently taken over kind of our traditional sales group as well, which historically it's been separate, but now that everything seems to be coming together, whether it be just products, portfolios, or just prospects in general, we're seeing a lot of crossover, as most people are. So now we're looking to combine those two organizations, and really going to step up our game now going forward, that we have a lot more product to sell on both segments of our business here. So yeah, been a long journey, coming up on 30 years, I think, at the end of this year. And I'm a lifer. I'm a suburban Philly guy, so it's very easy for me to work here at SEI.
Yeah, no, and it's a lost art, right? There's not too many. You look at resumes now, and people are moving very quickly, and it says something about you, and it says something about, I think, the culture, right, at that firm, right, and the opportunity. And as you know, we know SEI very well. You guys have been a long-standing client with us and do a lot of nice work with us. I think for our viewers, John, give everyone a few minutes on SEI itself, because I have always thought, personally, one of the, you're in a number of businesses, but the fact that you are an asset manager, I think, has given you also kind of some advantages kind of in the fund administration world. But I think people understand, kind of that your vantage point's probably different than potentially a lot of other fund administrators. But maybe a few minutes on just SEI in general, John.
Yeah, no, it's to your point. It's fairly unique, diversified financial services organization. I mean, we are a fund administrator, one of the larger in our space. It's actually the largest revenue generator within the SEI organization. But to your point, there's also an asset management arm here that's got about $400 billion in assets under management, mostly we'll say kind of long only traditional managers platform. They're beginning to expand the alternative segment. Hasn't been a ton of crossover though, I would tell you, in the two organizations. Just to, the way we look at the marketplace and the way the asset management group looks at the marketplace, just a little different, right? They're
Yeah.
obviously very concerned with performance and staying in there within their boxes of strategy. And we're taking a completely different approach. We want to, we're looking for those growth managers that fit well into what we do. So it's a little different. There's also another portion of SEI, a technology arm that we call our banking segment, which is selling trust technology to banks not only in the U.S. but globally, regional and commercial. And that's another kind of segment of the firm that kind of plays in our space, not directly, we'll say. We don't have a ton of crossover with that group either. So again, asset management, technology, and services, which we call ourselves IMS, Investment Manager Services here. So really three segments of approaching the marketplace, just not really a lot of overlap. So it's a little different to your approach about how we view the market and how the others view it. It's different, but it does allow us to leverage a lot of things internally. Our technology group here is fantastic because we have all those other segments that we can leverage there. And we're publicly traded. I mean, I think that's something that is, in the fund admin space, we'll say is maybe a little unique, not entirely unique. Independent, publicly traded organizations. Again, we're not a bank, so we don't have to play the bank regulation space. And we're not a private equity owned organization, which I think we all get in the fund admin world. A lot of private equity players are touching a lot of organizations there. So yeah, to that point, very, very diversified organization here. I think right now we're trading about 8.5 for $9 billion in market cap, but very, very stable organization. Again, hence the reason I've been here for so long.
Yeah, and a beautiful campus out in Oaks and PA. And I think you make a very good point about publicly traded, right? Not too many, believe it or not. There's still over 600 fund administrators in the market. Many of them independent. Only really some of the you guys play with the big dogs and the high end of the market, and many of those publicly traded to the point you're making. A lot of that there's a lot of PE money in some of those firms. So John, what I want to talk about are a few topics and that I know are interesting to you, so I guess the first I'd like to talk a little bit about is private credit, right? And very active. It's a very unique asset class, and it's still very much a leader in the kind of asset gathering world, right? And we see the shift in PE from a bit from LBO to credit, right? And so just interested in what you think about that part of the market, how SEI thinks about that marketplace. I think it's a really interesting topic.
No, I think it's a good question because we've been reading a lot of headlines recently about how the private credit space might be getting a little crowded. Some of the returns are coming down. Obviously, interest rates are a major impact on that space. I would say, though, however, from an activity perspective, what we see, it's still the most active alternative strategy in the marketplace, as well as the best performing strategy in the alternative marketplace. So institutions are still moving assets there. There's new product launching all the time. We get a fairly significant client list in that area, and they're still launching new vintage classes. So it is an area that I feel like people are looking for what's next from a performance perspective, or what's the next alternative class it's going to be at. And specifically within credit, I mean, direct lending, you can consider private credit, is still a very active area. And I think the banks seem to be trying to get back into that space a little bit. There's a lot of partnerships occurring these days. And again, a lot of the organizations that we work with, some of the larger tier, are all still launching there. So from where we sit in SEI, that's still a pretty heavy growth engine for us from a new name and a new label perspective.
The point about the banks trying to get back in is interesting because they kind of had their lunch eaten for a while, right? Here,
big time,
right? In a big way, right? How do you find the competition for this? We've seen a lot of administrators shift from hedge to closed end, right, because of the growth, and now we're seeing the shift within PE for a lot moving, who have traditionally been kind of PE LBO firms are now certainly investing in PE credit. But do you find the market crowded in terms of competition?
It's funny that we see the same names almost every opportunity on the private credit opportunities for on the deals. And so obviously on the larger end of the marketplace that we see a lot of similar names on most of the deals. It's just not a cookie cutter solution. And I think,
Right.
obviously a lot of organizations like us, they want people to just fit into the model and make it a very extreme good margin on an opportunity, and private credit, direct lending, LBOs even. I mean, it's really hard to just kind of put them in a model and let them run. We believe it's one of our advantages in that we have a pretty strong willingness to do the harder products, evergreen products, slow pay products. These things that are always a little bit quirky in the private credit space are things that we're very good at. We've built a
Yeah.
good technology platform for that. So therefore, I think because of the intricacies of some of these newer private credit solutions, the higher end of them, or the larger players, are all equipped, we'll say, to handle it. And it's expensive. So I mean, it's one of those things where you got to have the technology, you got to have the people mostly that can understand how to
Yeah.
process those things. So yeah, I would say the usual players in the top five, we'll say, in your convergence rankings, George, that are in that space,
Yeah.
mostly most deals we're seeing anyway.
Yep. Now, then you take the other side, or the spectrum, and you're seeing kind of retail products are starting to ramp up, right? BDCs, interval funds, tender offer products, are launching with a lot of backing and a lot of interest. And I know from some of the things we've talked about and some of the data we're providing you, this is now kind of an interesting part of the market for you. So interested in you kind of sharing your thoughts on some of these. Well, I'll just call them retail products, right?
Definitely. Yeah. And again, another headline item, we'll call it, is just the new retailization of, alternatives. Lots
Right.
of democratization, anything you can think
Yeah.
of, you've seen the headlines for. And yeah, it's funny. And we've, obviously from the data we've compiled from Convergence, I mean, the market is not extremely large. It's just, even whether from a number of funds product or a number of assets. Now there's a couple of outliers there. B REIT and those types of products are significantly large, but the rest of the market hasn't really caught up to that yet. I would again go back into, the people we compete with, that have the ability to do registered products, historically to do ETFs and mutual funds and CITs. I mean, those are the organizations I believe that, they can kind of close ranks and come up with a good solution there. I mean, we feel like we're one of those organizations. We have a historically top five alternative platform, for alternative portfolios. And then we also have a significantly large traditional
Yeah.
platform for registered product, which we've been doing for over 45 years now. Actually, we have an independent trust for ETFs and CITs and mutual funds that just crossed over 100 billion this year, which is a pretty big milestone for groups that are just looking to, we need a board, we need a trust. Give us a solution for these types of products that are just saying, listen, we're not really sure of the whole model since we're historically alternative managers. And now we're getting into this retail play where we got to be nice to distributors and things like that. I mean, there's a lot of like nuances there that I think
Yeah.
alts managers are dealing with. And I think we have a really good solution here. Others as well. I just think when you can marry a top five alternative platform with a top five traditional platform, it's a really good fit for where we sit.
Yeah, and it's interesting. It creates once those retail investors are in this, right? And I don't think we're far away from hedge funds and private equity funds or venture capital funds being made available to people in their 401ks, right? It's coming, right? And
No, it's a
and
great point.
and it changes really a lot of the servicing aspect, right? Some of the tech, especially the investor servicing, right, is a really different model, right? When you
Oh
think
yeah.
about that.
I mean,
So,
just the volume, George, that you're seeing with,
right.
when you have, a $25,000 ticket or a $50,000 ticket to get into a fund, obviously they're going to follow with some significant volumes that, again, you're either comfortable dealing with that or you're not. I think, from a scaling perspective, it's something that fits in our wheelhouse. But again, to you, one of the points where you were heading there, even in the retirement market that we're seeing, stuff, again, data we collect from you guys, we see a lot of collective investment trusts with a alternative portfolio into these CITs, which is again something fairly new. It's obviously regulated, so that none of them are too crazy, I'll say, from a portfolio perspective. But that's just a newer market that we're seeing, and
Yeah,
it's some of our
yeah,
expansion.
yeah. I mean, it's just more on that democratization of all alternatives. To your point, um, you know, fund administrators having a global purview, you certainly are one, and we see lots of different interests in different jurisdictions. But I know you guys have just you guys are seeing just a lot of interesting activity in Luxembourg, right? And we've seen that from our data. I'd like you to talk a little bit about kind of the rage, right, in Luxembourg right now from kind of your perspective.
Yeah, it's any private asset manager, uh, anything we're seeing. I mean, I'm talking any product that's being launched to this in this kind of recent window is opening up a Lux entity associated with it. So you got to be prepared. You have there's I'm sure most people are familiar. The AML in Luxembourg is significant. Um, there's Lux Gap, which is different than US Gap, so you got to be prepared to do that. I would tell you every new product we get has a Lux sleeve that is in play and part of the solution that you have to have. Again, most of the larger players are comfortable there. We used to partner, and I would say, mid-teen 2015, before pre-pandemic, we would partner with a Lux admin over there just because we thought it was kind of a one-off solution. And then just pre-pandemic, we ended up getting our own license because it just
Yeah.
became so prevalent, and every opportunity we were running into, again, just in the private asset space, it was just a requirement to have. So we've been investing significantly in Luxembourg, which is a fairly outward, we'll call it a location only because it's a small domiciliation, depot services, all those things that are kind of sitting outside of fund admin historically. It's part of the solution now. So we've been spending a lot of assets in Luxembourg to get us up to speed, to be able to compete. We need to have broader solutions there. It is an area that you can't ignore it anymore. I mean, we used to deal with kind of Bermuda, and then we dealt with Cayman as being kind of the main suppliers of offshoring. Everything is in Luxembourg now. So
Yeah.
again, the
Why,
amount of
why
money
do
we're
you think,
spending.
John? I mean, do you think it's because of the investor? Do you think it's the regulatory authority itself? I think of Guernsey, Jersey, Cayman, Bermuda, Lux, but I think you're right. We're seeing this recent uptick, right? Well, what's your thinking on why?
Yeah, I think to your two bullet points you had just brought up. One is just the access to the European investor.
Yeah.
It's just something that they're much more comfortable going through. One is the regulatory pieces, but two, there's some tax benefits to Luxembourg. So, yeah, I mean, the European investor is important. And again, if you're opening up a large private asset perspective or product, you're thinking of maybe some of the sovereign wealth money coming through, whether they want to come through a U.S. Product, they would much more prefer a European entity to go through. There's lots of reasons, and I just feel like it's the product that's kind of in play these days, and I don't think it seems to be going away anytime soon. So again, you need to have all your pieces in place over there, and I mean, just hiring in Luxembourg is another thing.
Right.
We find a pretty big jump because there's a lot of different regulations in Luxembourg about how you pay your people. We're just getting used to that. I think we've been there with our own ticket now for 5 years. We're expanding our license over there, and like I mentioned, we're spending a lot of resource to make it a better solution.
Yeah. Terrific. So, as we head into we're it's I was looking at the calendar, and it's like hard to believe that Thursday's August 1st, right? Like 5 months left in the year, right? So curious right now, when you think about the market, right? I always like to talk about kind of headwinds and tailwinds right now, right? And in the market. What have you seen, John, from an SEI lens, right? The kind of what are some of the headwinds you think you're up against in the market, and then where do you think the winds at your back right now in the market?
Yeah, a couple of things. I mean, where's the growth coming from? Is a great question. We ask ourselves this all the time. Every week we have a management meeting about where do we need to start spending our resources. We've been spending a significant amount of revenue in the past, we'll say 2 or 3 years, kind of during the pandemic, to rebuild a kind of technology platform here, put a better look and feel on it. Sometimes your platforms get a little stale, we'll say. after a number of years. So we're getting ready to release a big technology release in Q4 this year. Moving into 2025, we're looking to hit the market pretty hard with that.
Yeah.
How do we improve in our efficiencies, right? At the end of the day, I think everybody's trying to find that what's the best way to do it. We're doing it with our technology. The one thing I believe, you mentioned Headwind, which I think we're spending money in this area, but we don't really have the right solution yet, is in AI. I mean, I think that's an area where a lot of people say we're doing it. We're creating efficiencies, we're dollars to the bottom line. Has anybody really seen that yet? And much money we're going to spend there to try to make it happen. I think SEI, as well as some of our competitors, are still searching for that. What's the right answer there? So that's, technology in general. We're spending money. We're coming out with a new release this year. Where do we go next? And I think AI is one of those areas where we haven't necessarily figured it out. I don't believe anybody's mastered it. I think you could,
Yeah,
you kind of
listen,
read
I
that from
think
the headlines.
you make a good point, right? I think everybody's got a little different definition of what AI is, right? For their business. I think about us, right? We talk about uh, what's the best way for people to interrogate kind of our database, right? And we talk about things like, and we're working on things this year for 25 where, you could have a concept like Amazon where you're looking for data and you put them in your basket and you get your artifacts that you want to a Siri type iPhone application where you just say, "Hey, Convergence, give me all of Fidelity's funds in Europe over $500 million." Right? Boom. Right. So I think it's a race on for AI and it's interesting because I don't think there's um, any limitations or barriers. I think people are super creative right now about what can be done, and I think people just got to find, you got to really figure out with your clients what they want, right, and what's going to help them, right, ultimately.
Yeah,
Um,
no, we're looking for the answer, and we're spending accordingly to try to get there. I think our clients are asking the questions, and how do we make things more efficient? How do we make it easier for them at the end of the day? Like everybody else
right.
that we compete with is trying to figure that out, and we're gonna spend, and we're gonna try to make it happen. We got a lot of people looking at it, so it's something that um, we're looking at. And just you would so going into the year, other growth areas. I believe one area that I didn't mention to you yet was the fact that we're launching. We've launched a access platform for advisors to get into alternative space. So I think that's another popular area in the marketplace. A lot of the larger groups are just looking for distribution solutions, and that's another area where you can expose yourself to the retail market, and that's another area where we've put some money into and launched a product this year, and we're going to be pushing forward that going into next year as well.
Yeah. So, kind of wrapping up then, John. So, as you think about long-term vision, right? We've talked about technology. We've talked about retail alternative products. We've talked about AI. Anything else jump out at you in terms of what's kind of in the SEI playbook now? So as you head into 25.
It's a it's a great question. I'll give you I'll give you some tidbits as to where we're thinking. And again, historically, we've always grown our business organically. We've never purchased another organization to try to for growth purposes. And there's some benefits to that. That's not a business
Yeah.
model that we've approached. I don't believe we're completely turned off from expanding the organization in that area. We look at a lot of players now, and historically we really didn't look at them, and now we look at them. I think some of the prices and multiples in those organizations are mind-boggling, but I think that's something where historically we never really looked at that stuff, and I
Right.
think that's an area where we looked. I mean, who knows what's going to end up? I don't know if we're there yet. Historically, we've always just tried to stay within our means, never get too far out in front of our skis on things, and we've grown at a very steady pace. Consider that maybe a little boring, but I think it's just been a business model that's worked for us. That's an area where I think we're a little bit different, and not that we're necessarily not doing anything, but at least we're looking. I think that's
Yeah.
a big step for us.
Yeah. Well, steady wins the race usually, right? To your point,
Let's hope.
and right. But M&A is a lot of ways to look at M&A, right? Believe it or not, and I'll just take the fund administration space. When we started this business 12 years ago, there were 400 fund administrators, and now there's about 640. So even though that consolidation has happened at the top, and you have, big acquisition players out there regularly making acquisitions, like say an SS&C, which hasn't done one lately, but much lately, but SS&C and Apex and some of the very acquisitive firms. Um, I think I think we're going to continue to see a flurry where people are looking to get into geographies, looking to get into certain asset classes maybe they're not in. Um, we've even seen a lot of interest in what I would kind of call bolt-on services. So I want to buy a managed IT company or an outsourced CFO, CCO company or a managed IT firm or a third-party compliance firm. So, we're seeing a lot of administrators think about kind of bolt-on services and bringing, as much product as they can to the advisor so that advisor has, four vendors instead of 10, right?
No, I'm seeing. I would agree. I would tell you we look at it in two ways. One is, are you playing offense? And we believe we do a great job of playing offense and attacking the marketplace for the names that we want to work with. I think we go after them pretty hard, and we try to create those relationships and opportunities. But defense, I think, is where you're going with those bolt-on acquisitions. You got to play defense just to be able to protect your existing client base, just to be able to offer those solutions because they're going to need them eventually.
Yeah.
And then two would just be like, when you're out there presenting yourself and you're in you're in a beauty contest with the big shops, if you don't have those solutions, those bolt-on solutions that you referenced to, you're at a disadvantage. So I think, we're looking at it two ways. We look at those spaces. Again, I would tell you multiples are at a level that I'm not used to being a Delco guy. I don't see the I don't see the value yet.
And another deviation on that, right, is we're seeing a lot of administrators come to the same conclusion that listen, these valuations are crazy. I know people thought that in some of the big transactions that occurred in late 23. There hasn't been all that much coming to I call it coming to auction, right, in the market this year so far. But we've seen a lot of smaller plays, right, around the globe, right, where people are just picking up properties, picking up capability and products. So, I don't think there's a right answer. I think organic is still the way to grow, but I think you can augment that with some very deliberate and select M&A, and so it just takes. It's almost that to me that hybrid model can work well if executed well.
Yeah, and just remember, again, we're a publicly traded organization that has shareholders, and we're watching margins, and it's not just top line revenue for us. So just adding on organizations has been a bit tricky for us. We don't have any debt on our balance sheet, with or little debt that we have, and I think those are just areas that. That's the approach we take, and that's historically why we've kind of ended up just doing things organically. But private equity money they're a little bit riskier. They're looking to do consolidations. You mentioned a few of the organizations that are kind of serial consolidators in the fund admin space. Again, just different business model than we've taken in the past. But I don't disagree that people are looking geography specific. How do you do the around the sun service model, and we look at that as well.
Also, last point I'll make is we see a pretty regular influx of kind of European administrators who really don't have a U.S. footprint, right? And I think some of them have kind of figured out the hard way that you can't put 3 people on an airplane and open up an office in downtown Philadelphia and say you're in the fund administration business, right? You got to, So, all right. Well, listen, John, really a pleasure. One, I appreciate you doing this, and two, we've really enjoyed working with you and your team, and you guys have been a fantastic client and partner with us. So appreciate that. We're all about helping you continue to be successful. We think you guys are just a terrific story out there, and so I just want to thank you today for your time.
No, thank you too, George. I would agree. We love Convergence, and the data that you supply us is very helpful on multiple levels. So yeah, we think you guys do a great job. We're happy to do things like this with you and work together on various opportunities. So yeah, I appreciate you having me on. This was great to chat with you, and look to continue the growth.
All right. Well, listen, enjoy the 1 month of summer that's left with your family, right? And thank you again. Thanks for being on.
Great. Thanks, George.